Benefits with GBS Benefits. Welcome to Open Enrollment 2016. Time flies, right? It is flying. Yes, it is. So we're going to go through all of the benefits today. Certainly, this is your meeting. So please, if you have questions, let's talk through it. If it's something you want to, talk through while we're here in the group. If not, all of us are going to be available after the meeting for personal issues. So Open Enrollment, this is an opportunity once a year that we have to make changes, come on benefits, come off the benefits, take dependents off, make any changes. This is the time you want to do it, okay? Your benefits are effective January 1st. If you want to make any changes, the forms are available with HR. Remember, on flex spending, you do have to enroll in that every year. That is something that is not just carried over. IRS requires that we enroll every year, so keep that in mind. Once your elections have been done and in place, you can make changes through the year if you have a life event. Does anybody know what a life event is? Okay.
Marriage, divorce, birth, adoption, loss of coverage, gain of Medicaid or CHIP coverage.
Very good. You can read. The answers are right there. Thanks for playing. Also, loss of coverage. So let's say you're on your spouse's coverage and you choose not to come on the plan benefits. You can do that, and if they lose access to coverage, as long as you make an election change within 30 days, okay, you can make that change. So keep that in mind. And I like to play that out with you just so that you remember, if that ever happens, you'll remember that rule. Okay? Yes, question?
Not a question, but I did that last year.
Uh-huh.
And last year I was on my wife works for Weber County.
Uh-huh.
I was on her insurance, so we stayed on her insurance. And then our county offered the bonus rebate thing for not getting on the insurance. So I actually was paid $2,500 for not having our county's insurance. And then my wife lost her job, so that was a life event, so I wanted to switch over. But I wasn't able to just roll over without paying back
that opt-out?
$500.
Right.
So, I mean, that's just so people know.
So
They don't give you the choice not to take the money,
Here,
but
Jen.
if something happens, you have to pay that back.
Okay, so with the opt-out for this year, it's not going to be given at the beginning of the year. It's going to be given by pay period. So every pay period that we would normally take insurance premiums out, which is 24 a year, not the 26 that you get paid per year, you get $104. So that'll solve that problem. So if you need to go back on the insurance, we just stop paying out that $2,500 opt-out and start taking out medical premiums instead.
So the question is on the opt-out or on the loss of coverage? If you're
Well, that was just more than a question. It was just
sure.
It was just something that happened to me last year, and I know a lot of people
Right.
probably, if they were doing that this year, they wouldn't, unless they knew they were going to have to pay that money back if something happened during a life event.
Yeah, but to Janica's,
They made it to where I couldn't afford insurance for a year. I've been off insurance for a year.
okay. So you chose not to come back on. So we're taping this, and so I'm going to repeat what you've said because we want to make sure everybody's grasping. So it was stated that this gentleman was on other coverage, got the opt-out, and then lost coverage from his spouse, was going to come back onto the county's coverage, but because he was paid the full opt-out, he was going to have to pay that back. So this year, Jenica indicated that you're going to be able to get the opt-out, but it's going to be paid out per pay period. So you should not have that situation. Somebody shouldn't have that situation to have to pay back that opt-out money because it's going to be paid not on a lump sum, but it's going to be paid per pay period. So that hopefully will alleviate that issue. So thanks for bringing that up.
So there was another question that if your children that are under age 26 lose their coverage, can you add them onto ours?
Yes, so the question is if a child loses access to coverage, they're not on your coverage, can that be a life event to come back onto the county's coverage? Absolutely yes, as long as they do it within 30 days of the loss of the other coverage. As long as they're still under 26, of course. And of course, they don't have to be a tax dependent. So they can just be your dependent, so to speak, but not a tax dependent to be on your coverage up to the age of 26. They don't have to live home. They don't have to be in school. They can be married. If they're uninsured, then, and if they lose access to coverage, then as long as they you make application within 30 days. Okay? Thank you. So, updates, changes. We're pleased to let you know that Cigna will continue to be the medical carrier. No changes there. We're still offering the traditional and the qualified high deductible. If you choose to go on the qualified high deductible, that will include obviously enrolling in HSA. We're going to talk a lot about that and hopefully provide you with some additional information on the high deductible. Dental Select is still the dental carrier, which is great. We have added implants as a covered benefit. So that's great news. And we also increased the orthodontia maximum to $1,500. That's also great news. Opticare is the vision carrier. We're still offering the 120C plan. Question, does everyone recognize that your eye exam, your routine eye exam, is covered under your medical? Okay, I'm getting no's in the it looks like nobody knows that, and so I want to preface that yes, you can get your eye exam covered under your medical coverage. So I want to make sure and highlight that for you. Under the vision exam, vision coverage, that's more for your eyewear. Okay, so keep that in mind if you need to have a vision exam. Make sure you're using a provider within the Cigna network. Your employer, Box Elder County, is very generous. Know that as far as the benefits that they pay on your behalf. Most of the plan benefits that are offered are paid for the employee at 100%. The exception is medical and dental, but they are paying 85% of your premium. That's outstanding. I represent a lot of companies, and that's very unusual. So I just wanted to make sure and let you know that. If you choose to go on to the high deductible, your HSA will be funded by your employer, by the county. Okay? If you enroll as a single, and it won't be fully funded, I'll preface that, okay? But if you enroll as a single, the county will put in $1,125 into your HSA. If you enroll as a two-party, you and or spouse, they'll put in $1,687.50, and if you enroll as a family unit, they're going to put in $2,250 into your HSA. Okay? That's going to happen 2 times a year up to those limits that I've just explained. Now keep in mind, if you enroll on the HSA, IRS sets limits as far as how much we can contribute on an annual basis. So if you enroll as a single, it's $3,350, and if you enroll as a two-party or family, it's $6,750. So keep that in mind. The county is very generous as far as what they're putting into your HSA, and so I just want to make sure you don't overstate what that limit is. Okay? If you enroll on the HSA, you can also enroll on the limited flex spending account. So you may say, why would I enroll on the limited FSA? The health savings account allows you to pay expenses, deductible, co-pays, dental, vision, all of that can come out of that account. The limited FSA gives you the ability to set an additional $2,550 aside on a tax-free basis to pay for dental and vision. And Josh from MBS is here today, and he's going to talk a little more on that. And so we just like to make sure that you know that you have that availability. Dual coverage, just like to preface that dual coverage is not what it used to be. Back in the day, Alpheus used to complement your policies and pay 100%. That's no longer the case. So I just like to make sure and highlight that for you. If you have the ability to have dual coverage, consider, is it going to be worth it financially? With dual coverage and coordination of benefits, what happens is on a secondary basis, The secondary carrier will look to see what the primary carrier paid. If you have a deductible, you're still going to have deductible to pay. It's no longer 100% coverage. Same with the prescription. So what I usually will suggest is if you have access to being dual covered, consider putting the premium that you're going to pay on the secondary policy into an FSA or an HSA to pay for your out-of-pocket expenses. It also alleviates the confusion as far as accounting and who paid prime and who paid second. So dual coverage is not, again, what it used to be. So I just wanted to highlight that. And then the Hartford. We've got great news. Life, AD&D, voluntary, the rates held, so we don't have an increase. So that's great news. Healthcare reform, you're all here because you're offered full-time coverage. So you're full-time employees, you're offered coverage, you have access to coverage, okay? You can see what the penalty is. The penalty this year is increasing in 2016 to $695 per adult that's not insured, $347.50 for each child uninsured, or 2.5% of your income, whichever is greater. So the penalties are increasing. Educating you. DBS is available to you or to anybody that you know that doesn't have access to insurance. If you try to go out there and access insurance, it's pretty overwhelming. But we do have resources within GBS. We have an individual department. That's all they do. So help and support if necessary. On the back of the benefit book that we provided you, and hopefully you grabbed, our phone number, my phone number, and website is available to you. So if you have anybody in that situation, make sure you pass them over to us. And we'll be there to help them. Okay, so on your Cigna, this is pretty much a review for everybody. We're going to have the two plans being offered, the traditional and the qualified high deductible. The traditional is referred to the Open Access Plus network, so that's the network that you go through. The traditional plan is a $1,000 deductible, $2,000 family, and it's embedded. What that means, an embedded deductible means that if one individual meets the deductible in the family, a single deductible, the plan starts paying. So keep that in mind. That's kind of it can be looked at as an advantage on the traditional plan because you don't have to satisfy the family deductible. That's not the same on the high deductible. On the high deductible, the single deductible is $1,500, $3,000 for a family. So if you enroll as two-party or family, the family deductible needs to be satisfied before the plan starts paying. And that's what we refer to as the aggregate deductible. Any questions on that? Okay. Out of pocket. I just want to highlight this on the traditional plan. If you're in network, your single out of pocket is $4,500, and if you're in network for a family, maximum is $9,000. Okay. I heard earlier somebody's paid a lot more than that. So if you're paying a lot more than that, you shouldn't be. Let's chat. Okay. Again, I can be used as a resource and a support. I have an assistant in the office. We can look into the claims. We want to make sure you're not paying more than you should. And those amounts include your deductible. Okay. For the high deductible, again, single $1,500, family $3,000. Out-of-pocket maximum is $3,000 and $6,000. Okay, so if you enroll as an individual, maximum out-of-pocket is $3,000, including that deductible $6,000 in network for family. For your prescriptions on the traditional plan, if you are filling a prescription that's generic, that's tier 1, it's a $5 copay. Your tier 2 is a 30%. The minimum you're going to pay is $30. The maximum you should pay is $200. And then on tier 3 medications, that's a 50% benefit. Minimum is $50. Maximum you'll pay is $200, and that's per prescription. We're going to talk a little bit more as far as pricing, and I'm just going to remind you as far as the tools that you have available through both Cigna and through the GBS app, so that you can make sure that you're, and I call it an app, but it is a tool, so that you make sure that you're getting the best price possible. Okay. On the high deductible, remember that all of your cost on your prescriptions will go towards satisfying your deductible. Okay, so you're going to pay the retail cost of the prescriptions until the deductible is satisfied. Then it's going to start paying. The insurance will start paying. The retail costs are the discounted costs that Cigna has negotiated. So, you know, without insurance, a medication could cost $200, but with the negotiated discount that Cigna has arranged, it could be $100 that you're paying. Again, you're going to pay that retail cost until the deductible is satisfied. Okay, any questions on that? Preventative care, everyone knows, preventative care is covered at 100%. So that's your annual exams for women, pap smears, mammograms, men, PSA test. Your children, they have wellness exams during the year. Immunizations are covered 100%. You should pay nothing. One thing I want to make sure to highlight is, let's say you take a child in for their 6-month checkup, and for whatever reason they've been sick for the last couple of days. You say, you know what, he's had such and such, he's had a congestion. That's no longer going to be preventative. That's going to turn into a diagnostic visit. So you want to make sure you keep that visit as preventative, and if they have something other than having a visit, you'll want to make sure you schedule. Sounds silly, but I just want to make sure that you're not having a claim to pay that you thought was going to be paid at 100%. Primary care, under the traditional plan, you have a $35 copay for general doctors and specialists. Your urgent care is subject to a $45 copay. And urgent care is for something that, you know, you just don't feel good. You have a cold, you need stitches. Those kinds of things are urgent care. Your emergency room is the place you want to be for life-threatening emergencies. Life-threatening, meaning a heart attack, uncontrolled bleeding, unconsciousness. That's going to be subject to your deductible and 20%, but that's definitely the level of care you need. Okay. Under your high deductible plan, that's all going to be subject to your deductible. So your doctor visits, emergency room, urgent care, you're going to pay the negotiated discounted amount, but you're going to pay the full amount until that deductible is satisfied. So oftentimes we're asked, what's the difference? Financially, am I going to be better off on the traditional plan versus the high deductible? And so our actuary at GBS did this illustration comparison for us. So on here you can see that the traditional plan deductible is $1,000, $2,000 for a family, $15,300 for the qualified high deductible. He's also got here what we would pay for a single two-party family all the way across and what that difference is, and then what the county is putting into your account. Okay. So with that, he's put through in his calculator like 100 different variations. What if I enroll as single or two-party or family? What if we have hardly no visits or a lot of visits? What does that look like financially? So here's a few examples. So if you enroll as a single, have 2 office visits, 1 urgent care visit, what is my out-of-pocket expenses or exposure on the high deductible versus the traditional plan versus the high deductible? And he puts in there how much the county is putting into your account. So in this example, you would be $913 ahead being on that qualified high deductible plan. In my next illustration, this is an employee and a spouse. They had 7 office visits and a $30,000 claim. The example here is my out-of-pocket. Here is my traditional versus my high deductible out-of-pocket. Again, what the county is putting into my account. And in this illustration, you're $416 ahead being on the qualified high deductible. My next example is for a family. They have 4 office visits, which is, very low visits to the doctor, and then 2 ER visits. My estimated out-of-pocket being on traditional versus the high deductible, and again, what the county is putting into my account. And you're $921 ahead being on the high deductible. My next sampling of comparisons is pretty much giving you a feel for, had we have had no visits, just preventative care, enrolled as a single, all the way up to very catastrophic visits, 97% of the time you're better off on the high deductible, and in all of these overall you've saved $974 being on the high deductible. My next example is employee plus spouse coverage, and again 97% of the time, or $1,300 ahead being on the qualified high deductible. And my last illustration, I know I'm probably, kind of got the message through, but family coverage, 100% of the time financially, you're better off on the high deductible. And that's no visits all the way up to catastrophic, okay? The high deductible definitely is a different way to access services, and it's kind of frightening because, you kind of have to have that cash flow available in the HSA. And why is that? Because it works different than the flexible spending. On flexible spending day 1, if I put $2,000 aside, I have access to that day 1. On the health savings account, I need to build that account before I can have that money pulled out. So that obviously is a concern, definitely one that you want to be aware of, and definitely price your prescriptions, because you don't want to be faced with going to the pharmacy and not realizing what the cost of those medications may be. Okay? But I like that we have kind of a comparison. Jenica and Diane in HR have actually a book of 100 different examples. So if you're thinking, what, I really think I'm wanting to go to the high deductible, but I'm really not knowing how that's going to shake out financially for my family, get in touch with them and hopefully sit down, and hopefully we have a situation that would be similar to what you're looking at for your family. Kind of give you a better feel for what you'd be looking at. So your health savings account is a higher deductible, as we indicated. Definitely a lower premium. Coverage for preventative is covered at 100%, so there's no difference there. And all of the money that you put into your account is tax-free. So as long as you use the account that way, it's definitely advantageous, as I indicated, to be on the qualified high deductible. Better option financially. As I stated, you're limited to how much you can put into the account. So for a single, it's $3,350. For a family, $6,750, and that's on an annual basis. And that family deductible increased $100 this year for this next year for 16. So if you were to decide this year, yes, I'm going to go on to the qualified high deductible, you would enroll on the qualified high deductible, you'd establish your HSA, you'll contribute hopefully that difference. I kind of showed you there's a financial difference as far as premium. So hopefully that difference you'll put into your health savings account. You'll have the same take home, you're just sending money into your savings account that you own, and you will never lose to spend, for your qualified expenses. And then you'll pay for qualified expenses and hopefully watch your account grow. That's the hope and intent. So Cigna still has great resources for you. if you're looking to see if a provider is participating, go onto their website and access the Open Access Plus network. That's the network that you're set up with. And then you can locate a provider based on what type of provider you're looking for or for a specific provider. Cigna has great financial comparisons available to you, specifically for pharmacy. So if you're looking to fill Lipitor, you can see specifically on your benefit on how you're enrolled. If I fill the brand medication Lipitor, either through delivery, through home delivery or through any of the retail pharmacies, what is my out-of-pocket going to be? And it'll tell you directly what that amount versus filling that generic equivalent. So huge difference on filling brand versus generic. Okay, and that'll just tell you in detail based on your plan benefits that you are enrolled in. You're all probably familiar with submitting the health risk assessment and signed up to MyCigna, and you've done your health risk assessment for your points for wellness. So this is a screenshot of what that looks like. Cigna's got a gamified health assessment, so based on how many fruits and vegetables a day that you should be eating, and they've kind of put a fun game to it, so kind of helps track what you're doing on a daily basis. You can put your goals as far as your activity, as far as what you hope to accomplish, and how you are going to be eating, and your activity, and all of that can be monitored online on your phone through an app. Very user-friendly, so hopefully you're taking advantage of that. This is a screenshot of your mobile app. So if you sign up and you have a smartphone, you're able to find a doctor, print your ID card, or view your ID card. So if you go into the doctor and you don't have your ID card, you can just pull it up on your phone and show the doctor. It'll track your deductible. If you're looking to see if a claim has been processed, you can pull that up, so you have all of that information available through MyCigna. Cigna's got great coaching, this is totally voluntary. So they will reach out to you, and you may have received a phone call from them already. If you have a chronic condition like diabetes, low back pain, they are reaching out to you. It's a voluntary, confidential program. They are just having another resource available to you as a support, making sure that you're accessing the services you need, you're getting the services you need. You don't have to participate in the program. Again, it's voluntary, confidential, but again, if they do reach out to you, I think it's a great help and support, and again, it's meant to just make sure that you're getting the services you need. Cigna has healthy rewards programs, so programs like Jenny Craig, those are available to you at a discount, so make sure you're accessing that. Some tips as far as savings. Prescriptions, sometimes, not all the time, our medications are cheaper if we get them in bulk and through mail order. So make sure you're looking at that as an option. Using the urgent care, we talked about that. Using urgent care obviously is going to be a lot less expensive, and if that's the level of care you need, definitely a good option. Using the right professional. You don't need to have referrals to see the doctor. So if you feel like you need to go to a specialist, do know you can just go to a specialist without receiving a referral. And then being proactive, getting your health exams, being proactive as far as staying current on preventative care. Cigna is available 24/7 by phone, on the internet, or on your mobile site. Maximizing your benefits, just a quick reminder, have a doctor, okay? Simple. you may be very healthy, not have established a relationship with the doctor. You don't want to find yourself in an emergency type situation where you don't have a doctor that understands what's going on and what your health history is. So if you're healthy, and that's great, but do try to establish a relationship with the physician so that they're familiar with your case history. Pharmacy savings, we've talked about this not too long ago, but remember generics, samples, pill splitting, financial assistance is available sometimes on medications. So make sure you're taking advantage of those savings. GBS RX comparison tool. Hopefully everyone's put this on their smartphone, okay? This is not an app, it's through the GBS website. So our website, www.gbsbenefits.com, and you'll just click on the icon that's on the middle of the page and put it on your smartphone. It'll ask if you want to just save it. I had a situation just a couple of weeks ago filling a couple of prescriptions for my husband. Went to Smith's. And they said $100 for one medication, $85 for the other. I'm like, wow. So I pulled up my tool and priced it. And at Walmart, I could fill one of the medications for $10. I'm like, this is telling me I can go to Walmart for $10. And he's like, I would go. He put the discount, he put the code into the computer and said I could give you the one for $65. And I go, that's still worth a trip down to Walmart. So I got in my car and I looked again and saw that at Sam's, one of the medications was free. So sure enough, I went down to Sam's. I have the Plus card, so that costs us a little more during the year. So instead of, I think it's $45, it's now $100, right? But that's a year. For those same medications on my Plus card, one of the medications was free and the other one was $10. So that's a real life example, and I encourage everyone, this is not something you have to purchase. Like I said, on Sam's, I had the Plus card, and so I pay a little more for that, but that's an annual membership fee. But certainly, that's quite a savings to me. So hopefully you feel the same. This program is free. You'll just put your medication name into the site where you're filling the medication, and it's going to price compare, provide you a coupon. You can decide based on what you know with the Cigna site, what you know on the app, or on the GBS tool, what's my better option, okay? And like I said, the guy at Smith's, he was really being cute with me. He's like, yeah, for $185, I'd go there too. So, and he had the medications already filled for us, but you know, that's quite a savings. So I encourage you to make sure you're using that site, okay? That's what I have for a minute. I'm going to turn the time over to LJ unless you have any specific questions for me. Okay.
I feel important.
You are important.
Clipping myself on here. Okay. Thank you, everyone. Good afternoon, and it's good to see everyone here. So thank you for taking the time to be here so we can go over your benefits. It is the Platinum. That is the name of the network, okay? So when you go to our website, we have a phone app, or if you call our Dental Select member service team, that is the network. On the Platinum plan, we have like 3,000 providers that are on this particular plan. So you can go in network or you can go out of network. Just remember that when you go use one of our providers, our dentists, we've negotiated the rates with them. So it's going to be less out of pocket for you. If you choose to go out of network, we're going to base our payment on what we call the RNC, which is the reasonable and customary. So on this particular plan, your deductible, your individual deductible is $25. Family deductible is $75. Now that deductible only applies towards your basic and major services. It does not apply towards your preventative. Your maximum, your annual maximum, it will start off at $1,200 per person. So let me explain this, okay? So your annual maximum starts after you've satisfied your new hire waiting period with your company. It will start when you become eligible on your Dental Select policy. So let's say that I started in July. So okay, this is what we call a max reward. So each year that you're with Dental Select, we're going to increase that. But it will start with your effective date with Dental Select. It's not on calendar, it's when you're effective, you become eligible with Dental Select. So next year, the second year that you're with Dental Select, we're going to give you $100. That's going to bump it up to $1,300. So now you have $1,300 that you can use for your preventative, basic, and major services. The third year that you're with us, we're going to give you $200. Okay, so that's going to bump it up to $1,500. So you have a rolling maximum, and it will cap out at $2,000. So if you want to know what your maximum is, you can log into our member service website, create your password, and you can look at your policy, or you can just give our member service team a call and we'll let you know. Your preventative, when you go in network, one of our contracted dentists, your cleaning exams are covered at 100%, 2 times in a calendar year, anytime. So try to go in each year to get your preventative to stay healthy. If you go out of network, then it's going to be covered at 100% of the reasonable and customary. Your basic, which is going to be fillings, extraction, oral surgery, perio, treatment of any type of gingivitis, gum disease, endo, which are your root canals, we will cover that at 80%. You're going to be responsible for the other 20%. Your major services are going to be crowns, bridges, dentures, and surgical implant. Like Denise had explained earlier, that's a new benefit starting in January. We're going to cover that at 50%. You're going to be responsible for the other 50%. So let me explain to you on this surgical implant. Okay. It's the post, and then we'll cover the crown over the implant. If you're on this policy, and if that tooth has been missing prior before coming on, then there is a 3-year missing tooth clause that you have to satisfy before we'll cover the implant. But let's say that you've been on with Dental Select for the last 4 or 5 years, then there's no missing tooth clause. Okay? And another thing that I do and Dental Select suggests is if there's anything over $300, you go to your dentist and he gives you a treatment plan. We highly recommend that they have sent over a predetermination to Dental Select. Predetermination comes over, you give us a call, we let you know what your out-of-pocket cost is going to be before you have the service done. And this also has a ortho benefit. Children up to the age of 19, we're going to cover 50% up to that $1,500 per child on your policy. There's also a 20% discount for an adult if you use one of our orthodontists. You can go to our website and let's say I'm over age 19, I still want to get some braces, so I would go to one of our orthodontists, Dr. Smith, and then he'll give me a 20% discount off of that $4,000. And then just make sure that you are aware too that if you're adding dependents or your court order to add dependents, they still have to satisfy that 12 months waiting period for major and ortho. Okay, so on this rolling maximum, where we increase it, so you've been on the policy for 6 years. So you, yourself, me, I'm capped out at $2,000. That's what I have. That's my benefit. That includes preventative, basic, and major services. But guess what? I got married, okay? So now I'm going to add my husband to my policy, okay? So my husband is going to have that 12 months waiting period, and he will have to start off at $1,200. He won't be up to the level that I am. Questions on that? I'm not really getting married. So just make sure that you understand that rolling maximum, and then the increase, and then your the implant benefits. Again, if you ever have any questions, concern, reach out to our customer care. Call Dental Select and say, take a look at my policy. This is what I'm going to have done. Keep healthy by going to your dentist 2 times in a calendar year for your cleaning, exams, and x-ray. And then anything over $300, predetermination. And you're always welcome to call me if you don't want to be on hold at customer service. Call me. My number is 801-495-3000, extension 129. Good. You guys are picking up your pens and you're writing my phone number down. I like that. Again, thank you, for being here and letting us provide dental insurance. I appreciate each and every one of you. And stay safe.
Maddie?
You guys awake? Everyone gonna hear me? We're all good? Okay.
You don't have to take this off. I have to hook it onto my necklace. It's not a clip-on.
It's not a clip. Okay. Yes. I don't know. Yes. Sorry. Oh no, it's a second one. Okay, I'm gonna hold it like a microphone. Okay, my name's Maddie. I am with Opticare of Utah. There have been no changes to your vision policy this year, but do we have any employees in here or anybody on your policy who have used the sunglass bonus before? No? Are you guys aware of what the sunglass bonus is? No? Okay, let me explain it to you. So what the sunglass bonus is if you are on the policy and you don't need glasses or contacts that plan year, or if one of your dependents doesn't need glasses or contacts, what you can do is you can go into any of our in-network participating providers and use your frame allowance towards sunglasses off the shelf. So you can walk into Standard Optical and get sunglasses that can retail up to $120, and that will exhaust your benefit for that plan year. Or you can fall into the broad network now, so somewhere like America's Best, Vision Works, and Shopco, you'll have a $100 allowance for off-the-shelf sunglasses. So that's how that sunglass bonus works. Your breakdown of your plan, the Select network is Standard Optical. You'll see that you've got it's 100% covered for the single bifocal and trifocal. Now, depending on what type of material your lens is made out of will determine whether you have a copay or whether it's going to come at a discount. And then you'll see that the frames or contacts, you'll have a $120 allowance. Please remember that they are in lieu of each other. Typically what I recommend to members who have somebody on the policy who wears both is to exhaust your benefit on contacts, because once you've done that, you actually qualify for an additional pair of eyewear up to half off. So Standard Optical will honor 50% off, and then if you were to fall into the broad network to get those additional eyewear, they'll give you up to 25% off. So, and then you'll notice, again, when you fall into the broad network, you're going to have a $10 copay now for the single, bifocal, trifocal, and then your allowance drops to $100. Also, please keep in mind that you are dealing with retail products. So just because that allowance is lower does not necessarily mean it will get you less. I like to recommend that you kind of cost compare where you're going. And another thing that I also recommend is that if you're looking for the most cost-effective route for a pair of glasses, is to fall into your broad network for your frames and then take your frames into the Standard Optical, because you have better coverage on your lenses in there. So if you also want to go to a doctor that doesn't fall into our panel, then you're more than welcome to. You still have a very rich out-of-network benefit. It's going to work a little bit differently. Instead of utilizing your benefit at the time of service, what you're going to do is you're going to pay upfront and in full. They will give you an itemized receipt. You're going to call Opticare and we'll walk you through the reimbursement. You go online and pull a PDF and then send it in. It's super simple. So we'll reimburse up to $85 on lenses, $80 on frames, or $80 on contacts. that's pretty much the summary of your plan. I do have a more in-depth description of the plan on this table over here if you want to grab any. Do you guys have any questions that I didn't touch bases on?
So the only Select network is Standard Optical?
Right.
That's it?
Yes. So the Standard Optical is the only provider that falls into Select, but you do have other providers you can go to that will fall into the broad network. Okay? Yes?
On the checking of the eyes, what does that all cover? For your eye checks?
Your eye exam,
Yeah.
that would fall under medical. So this is a hardware only plan. So we cover the glasses or the contacts. Yeah, the eye exam will fall under medical.
It's just a routine eye exam. If it were to be something that's outside of routine, then it would fall under the specialist
Right.
copay.
Okay, well, mine every year have to be over the routine, so.
Do you have a pre-existing condition? Because I know that sometimes that will determine whether it's routine or whether it's diagnostic.
So they have to check for retinopathy every time I go in.
Right.
Which is
Anytime they
special.
dilate your eyes or do that low end, that does cost you extra. That does not follow under the routine.
Preventative, yeah.
Right.
Yeah, exactly.
Right. Okay.
So one question, Maddie, is can I get my eyeglass benefit out of network?
So you cannot use the sunglass benefit out of network. You cannot go and pick a pair of sunglasses and then submit a receipt. It has to be an in-network participating provider. So pretty much any of our chains should be willing to participate on that. Where it's going to get a little bit more complicated and we're going to have to do a little bit more work is if you're going to like an independent optometrist or ophthalmologist. If that's the case, please call Opticare. We will call the provider and talk to them and make sure that they're willing to participate and then give you a call back and let you know, because we don't want you guys to go there and then have, a big mess and it have not work out. So, okay? Awesome.
Thank you. Okay, so just a quick review again on the high deductible on the HSA. So remember, your health savings account is an account that you own, just like any other bank account that you have at the bank, okay? They are federally insured up to I think it's 250,000. I had that question yesterday. So do rest assured that that money is safe. It is to pay, your HSA is to pay for qualified expenses, just like your flexible spending account, okay? So that includes dental, vision, co-pays, deductible. Okay. One other good feature of the HSA is you can also pay for COBRA, Medicare, or long-term care premiums. So this is meant to be like it's oftentimes referred to as a medical 401k. Okay. You may find yourself unemployed at one part of your life and have to pay COBRA premiums. Everyone knows COBRA premiums are pretty expensive. So this savings account of money that you've hopefully built over time can pay for your COBRA premiums. You cannot be insured on Medicare when you're on an HSA putting money into it, but if you're no longer contributing money to an HSA and now you're on Medicare, you can pay your Medicare premium out of this account. Or you can pay long-term care premiums from this account. So that's always good. Something I'd like to highlight, good to know. The HSA is an advantage because you have a lower premium. We talked about that earlier. All of the money that goes in, any interest you earn, and any money you pull out to pay for your qualified expenses, you never pay taxes on it. I'm often asked, well, what kind of interest is it going to bear? Not a whole lot. What the market's bearing right now, which is, what is it, minus 0.5? I mean, minimal, but there is some interest to earn. Your funds roll over year after year. So unlike the FSA, on the FSA, you have to have a crystal ball, know how much you're going to spend. If you don't spend it, what happens? You lose it, okay? On the HSA, actually, the hope is that you're going to build that account over, and hopefully you're going to have money to roll over year after year and build that account for future expenses. If you leave the county, the money that goes into that account is yours. So if you leave the county, you don't have to pay back the money that they've put into your savings account. Okay, so know that money, once it's in your account, that is your money. If you leave employment with the county, go somewhere else. If you enroll on a high deductible plan, you can continue putting money into that account. If you go onto a traditional account, that money is yours to pay for qualified expenses for life. So who's eligible? There's some requirements. You have to be enrolled on the qualified high deductible. You have to be at least over 18 years of age to establish an HSA. You cannot be enrolled on Medicare or TRICARE, and that's any form of Medicare, just so you know. You cannot be double covered, so if your spouse covers you on a traditional plan, that disqualifies you from getting a tax advantage on the HSA. That's something that is applicable to you and your family. Let's talk through that, because I think there's some ways that we could look at, how you could manage that. You cannot be claimed as a dependent on someone else's taxes. So if you're married and filing jointly, you can, that's fine. One thing I like to highlight is our adult children can be covered on our plan until 26. They don't have to be tax dependent on us. That same non-tax dependent, you cannot use your HSA dollars. Okay, that's an IRS rule. Again, if that's something that applies to your family, let's talk through that. So again, that adult child is 24, they're gainfully employed, they're living on their own, they can be on your insurance, you just cannot use your HSA dollars to pay their expenses. Okay, and that again is an IRS rule. And you cannot have other coverage. So your family cannot have another regular FSA that disqualifies you from being on an HSA, and you cannot be double covered on a traditional plan. So how much can I contribute into my HSA if you enroll as a single? As much as $3,350 in a year, and that's a calendar year, and as much as $6,750. Again, that includes what the county is putting into your account. And if you're fortunate like I, over 55, you can actually do a catch-up each year of $1,000. So each year you could potentially put in $7,750 into your account. Okay, and that's an annual catch-up, and that's for the owner of the HSA. So if your spouse is over 55, they're not the owner, so just you could take advantage of that HSA contribution or catch-up. Now, I'm going to turn the time over to Josh, and he's going to talk through the FSA, unless you have any specific questions for me. Okay, Josh? Put it on.
All right, so my name is Josh. I'm from National Benefit Services. We administer your flexible spending plan, your limited flexible spending plan, and your dependent care plan. The flexible spending plan is a way, like the HSA, that you can pay for qualifying medical expenses with pre-tax dollars. The way that it works for the flexible spending plan, you make an annual election at the beginning of the year. The limit, as it says up there, is $2,550 that you can put away. And the nice thing about a flexible spending plan, and the reason it's called a flexible spending plan, is because day one of the plan year, you have access to the full amount of your annual election. Health savings account, you don't get the money until it actually goes into your account by way of payroll funding, a little bit out of each payroll. The FSA, you're going to fund the same way. A little bit out of each one of your paychecks is going to come out pre-tax, but you have access to the full amount as of day one of the plan year. So that's one of the advantages if you do the flex plan. It can work as sort of a short-term loan to yourself. You don't pay any interest if you use your full $2,500 during the month of January. I'll talk a little bit more about the limited purpose FSA because you can have a limited purpose FSA that covers dental and vision if you're in the high deductible plan and have the HSA. And I'll talk a little bit about why that might be advantageous, but we'll kind of do that at the end. The dependent care plan is if you're married filing jointly and you and your spouse have to put your dependent children age 12 or younger into some kind of daycare so that you can both work, then you can put up to $5,000 into the dependent care account, elect that much, or if you're single, up to $2,500. And you have two choices on how to get a tax break on your dependent care expenses. You can either use the dependent care plan, or you can use the child tax credit on your personal income taxes. For most tax brackets, the dependent care plan will give you better tax savings if you go that route rather than make the claim on your income tax. Now, one thing I wanted to tell you about, there are two ways that you can access this money and get your claims reimbursed to you. The first way, the most convenient way, about 85% of the claims that we see at NBS now are by way of your debit card, your NBS debit card. If you currently have an NBS debit card, it's a Blue MasterCard, you're not going to get a new card when the new plan year starts. That card will work to make your funds for the 2016 plan year available as of January 1st. So you're not going to get a new card. That's the easiest way. Go to the store, go to the doctor's office, swipe the card. It'll automatically access those funds. The second way is by submitting manual claims to us. And there are claim forms available on our website. The easiest way by far actually to submit claims is by using our mobile app. Did anybody know that we have a mobile app, the NBS mobile app? Go to the App Store, type in NBS Mobile. You can download it for free. Then you have to log in. The two pieces of information you'll need to log in and create an account are your employee ID, which is your social security number, and your registration ID / employer ID is a special number for Box Elder County. It's, if anybody wants to write it down, if anybody's interested, it's capital NBS. Those three letters are all caps. 598532. NBS 598532. I love using, one day I went to the doctor, I forgot my debit card, so I couldn't pay with that. I paid out of pocket, but with the mobile app, it was so easy to get reimbursed. All I did was pull out my phone, log into my account, fill in the information on the screen, $25, go to the drop-down menu, change it to copay to identify what kind of transaction it was, take a picture of my receipt on my phone, hit submit, and I was done, and I got reimbursed. It's that easy to submit claims that way. So if you're in the traditional healthcare plan, the regular FSA is a wonderful way to save money on taxes to get some of the same benefits that you get from an HSA. There is a 75-day grace period. That means that if you haven't used all your money this year during 2015, you have until the middle of March to incur new expenses in order to use your 2015 money. You have 90 days to submit claims, so after the end of the plan year, so you have until the end of March to submit any receipts and things to us in order to get reimbursed for claims that you incurred between January 1st, 2015 and the middle of March 2016. I just wanted to talk briefly about the limited flex plan. You can get into the limited flex plan, as I said, if you are enrolled in the high deductible plan and you're enrolled in the HSA. Now, what is the ideal outcome for your HSA money, the money that you put into your HSA? What's the best possible thing that can happen?
You don't use it.
You don't use it, exactly right. And why? And if you don't use it, it's so good because what does that money become if you don't use it? It becomes another way to save for retirement because after age 65, if you take the money out for something other than a medical expense prior to age 65, you have to pay taxes on it and you have to pay a penalty. After age 65, you still have to pay taxes on it like it's income if you pull it out and use it for things that aren't for medical expenses, but you no longer have to pay the penalty. So it can work as a great vehicle to save money. And you don't want to, hopefully you don't have to touch it. Now, the limited flex plan works for people who are putting away the maximums into their health savings account. You're maxing out your health savings account every year, which is $67.50 for a family and $33.50 for an individual. If you're putting that much away and you still have vision and dental expenses, then the limited flex plan may be a great way for you to pay for those expenses with pre-tax dollars, so you're not paying taxes, you're getting that bonus, but then you're having the added bonus of not touching the retirement fund. So if you're in that situation where you're putting the full amount into the limited flex plan, or into the HSA rather, you may want to think about doing the limited flex for some of your other expenses so that you can really save that money for retirement, but still get tax savings through the limited flex plan, through that other vehicle. Are there any questions about that? About limited flex plan, about regular flex plan, about the dependent care?
To what age can I use dependent care for my children?
Kids ages 12 and younger. If your child is 12, you can use the dependent care plan in order to pay for those expenses. If your child turns 13, you can no longer use your dependent care. Good question. Any other questions for me? We appreciate you guys very much in letting us come and talk to you about these things. I'll be here after if anybody has any specific questions.
Thanks, Josh. So just a quick review on life insurance. Your employer, the county, is paying for full-time employees. Your basic benefit is $25,000. If you should die due to an accidental injury, that's double. And your spouse is covered for $10,000 and each child $2,000. You do also have access to enrolling on additional life insurance. You can do that through evidence of insurability. Do I have any new employees here within your new higher eligibility? Okay. The reason I ask is because there is a guarantee issue for those that are in their new higher waiting period or eligibility period. So we won't talk about that. One thing to know on the voluntary life, and I don't think this applies to anybody here, but your voluntary life does reduce based on age. So reimbursement reduces when you're 65, when you're 70, and when you're 75. So just so you know, I like to highlight that for you, okay? On your life insurance, update your beneficiaries, okay? Most important. Cigna does offer the EAP assistance program, and oftentimes we have situations that are difficult through life and we need that additional support. This is confidential. They're available to you 7 days a week, 24 hours a day. Make sure you reach out to them and get that additional support, and it's confidential. And then lastly, again, update your beneficiaries on both life insurance, and if you're enrolled on the high deductible and have an HSA, what happens to your money if you pass away? It goes to a beneficiary. So make sure you've updated your beneficiaries on the health savings account as well, okay? Very, very important, okay? Any specific questions for me? Okay, thank you so much for coming out this afternoon. I'm going to turn the time over to Washington Mutual, and they are going to talk about the voluntary plans that are available for you.
Is this complicated?
Well, it hooks on to your, right there.
Okay.
Right onto your collar.
You might have to do that. I'm a blind, you know, it's difficult.
It's not so easy. Okay, there you go.
Put that in my pocket? Okay. Thank you very much.
Oh, one other thing, did I tell you guys? My name, phone number. Okay, if you need help.
Good afternoon. I'll make this short and sweet. I know it's dark in here and everybody's probably going to go to sleep here. I'm Patrick Howard. In the back there is Michael Weber. We're with Washington National Insurance Company. They're a 110-year-old insurance company. We've offered benefits through the county here for probably around 25 years. And we're going to talk about a cancer plan, an intensive care plan for any reason at all, and an accident. This coverage has nothing to do with any other insurance that you have. We don't coordinate benefits with any other insurance company. Even if you get injured at work and workman's comp's paying you, you still get the checks from us. And you can put it in the bank, spend it on anything you want to, have to, or need to. So this is your money, period. It's to help pay the overage that your other insurance didn't pay. And if you quit work, change jobs, or retire, you get to take this coverage with you at the special price. And the reason why that's important, ever so often, and I'll answer the time period on that here in just a little bit, the company sends you a check for every single penny that you paid into this back to you, minus any claims. And it starts all over again. So this is something that you probably, I'm 65, I'm going to keep mine forever, and I've just got on Medicare, the A and B, and this is a good little Medicare supplement because it doesn't have anything to do with any other insurance, and it's cash to me so I can pay wherever I need to pay it. So with that being said, here we go. If y'all have any questions as I go, just fire away. And that one too. So I'm going to tell you about the cancer plan first. Seems to be everybody's first concern. The American Cancer Society basically tells us, cancer hits 1 out of 2. It's a number 2 killer. It's the most expensive disease out there. When I first started in this business 31 years ago, an internal cancer situation is about a 50-50 deal whether you made it or not. Now the 5-year survival rate's right close to 70%. So if you catch it in time and you have enough money, you can beat it, and a lot of people are. But they're still accumulating a big pile of money that they got to pay off for a long time, after you wipe out your savings, retirement, and 401s. I'm a blonde. I might have to get directions on this one. Anyway, and that's after you wipe, like I say, after you wipe out your savings, retirement, and 401. Well, we have a solution to prevent that part from happening. There's 2 costs with cancer. There's your medical and your non-medical. Last year, Americans spent over $263 billion on cancer. 39% was paid out for medical costs, which your hospitalization should pay. What people don't realize until they're in the middle of this mess, 61% of that figure came out of our back pockets through other related expenses like deductibles, co-payments, benefit limitations, taking off work, trips to and from the treatment center, paying your personal monthly bills, loss of income. That's where we come in to help you out. Your guarantees from Washington National, I'll reiterate some of these. The money's paid directly to you regardless of any other insurance that you have. Your benefits are never reduced as you get older. There's no lifetime maximums on many of the benefits. Premiums don't increase due to age. You're guaranteed renewable for the rest of your life. Great benefit. Can't be singled out for a rate increase in our world famous return of premium. So on the cancer benefits, like I said, this pays on any type of cancer: skin, blood, bone, tumor, leukemia, Hodgkin's. If you get diagnosed with any internal cancer, we immediately overnight you $1,000. You can bump that up to $10,000 like I did. My rate that I get is exactly what your group rate is, and it's locked in for you. So we got you taken care of that. And then we ask that you contact me or Michael on a claim. We like to get involved. People don't like to file claims. They mess them up, get road rage, and start killing people. So we can take that stress off of you. When you got to file a claim, call us and let us give you that good service you guys certainly deserve, and we'll help you through it, get your money fast and with no hassle. And if we're dead and gone, we have our signature feature, the Health Advocate. They'll do the same thing for you. Then we start paying you an income of $200 a day or $6,000 a month. That's the very first day in the hospital up to 30 days. Then it goes to $400 a day or $12,000 a month from that point on. There's no maximum. You get $70 a day daily medical care with doctors and testing. There's some breakthroughs in cancer right now because of modern medical technology. So there's a clinic in Boston. They're getting famous nationally in pancreatic cancer. Used to kill us. Now they're saving us. Okay, MD Anderson in Houston, they've got a high cure rate for breast cancer. So that's where the women may want to go there. There's another clinic getting famous in Atlanta, Georgia for prostate cancer. So you might have to go out of state on the other side of the nation. You can go anywhere you want to. We're going to pay up to $1,500 each way. That's $3,000 round trip every time you go, where you go, how you go, when you go. And a family member gets to go with you every time as well. We'll even send you all the National Cancer Institute for consultations so you can kind of educate yourself and weigh your options on which way you want to go. There's no limit to the number of trips. We can pay a lodging benefit at $60 a day up to 60 days each time so family can be together. We have an ambulance benefit, helps out getting you to and from the treatment center if you're real sick and can't make it any other way. So folks, if you'll stop and think, everything I just showed you here, your major medical really doesn't pay a penny on, and on a real cancer case in your family, you will have to come up with some of that money for sure. Maybe all of it, I don't know. And where are you going to go? Well, savings, retirement, 401s and such like that. So we got that taken care of. But where we really pay the most starts from this point on, because everything's paid in or out of the hospital. You got a second and third surgery opinion. Your surgery pays up to $7,500. Anesthesia is another $1,875, so that brings it up pretty close to $10,000, even if your other insurance pays it all. Reconstructive breast surgery, actual charges, pays on blood and plasma. Prosthetic devices pays if they're surgically or non-surgically implanted. Radiation and chemotherapy pays actual charges up to $250 a day. And this pays in or out of the hospital or self-administered, and there's no monthly or lifetime maximum limit to this benefit. So we'll use my dad for an example. He had a cancer in his jaw. They had to remove his jaw, and the doctor backed it up with radiation treatment. Well, he had Medicare supplement. So if you do the math, 250 times 40, that's $10,000 that was sent to him. He put that money in the bank, and you know that makes you pretty happy on a deal like that, because it's your money to spend any way you want to, have to, or need to. It also pays on comfort drugs, stem cell transplant, bone marrow transplant, wigs and hair pieces, skilled nursing facility, hospice for the terminally ill. This starts out paying $100 a day the first 60 days. That's $3,000 a month, $50 a day, unlimited after that, so you can get some good care either way on that one. And we also have alternative care if you want to try something new or different on the market. That's the cancer plan right there. This next part I'm going to tell you about, this is a rider that hooks onto your cancer plan. It's an awesome benefit. It's something you'll find in very few policies written today. But if you or your spouse or your kids, and by the way, your kids are covered up to age 26, whether they're living at home, period. And but if you or your spouse or your kids go into intensive care or critical care for any reason whatsoever, it doesn't have to be cancer, get sick, have an operation, accident, whatever, the adults get $500 a day. The children over a year get time and a half, $750 a day. Our most popular intensive care claims a vehicle accident, and I always tell them I-15 will back me on that. It pays double benefits on that, so that's $1,000 a day for the adults, $1,500 a day for the kids. And it also pays on a subacute intensive care, a daily blood and plasma, and an ambulance benefit. So let's talk about this for just a second. Let's say me and the wife and one of my kids, we're up here, we're going into Salt Lake to do some Christmas shopping, and boom, we get in a car wreck. There's a bad one. We're laid up for 10 days in ICU. What's this thing going to pay me? What's $1,000 a day for the adults? $1,500 a day for the child. So that's $10,000 for me on a 10-day event, $10,000 for her, $15,000 for the child. That's $35,000. That's some pretty serious money if you need it. You just hope you don't need it, but the peace of mind's priceless. It's there. God forbid if you need it. The last part, excuse me, is for accidents. And you guys are covered every second of the day, on the job, off the job. We had a gentleman here that got injured on the job with the fight and one of the prisoners and hurt his shoulder. Workman's comp was paying him. Well, we don't coordinate benefits with workman's comp, so again, he's going to get that money. But you're covered every second of the day, on or off the job, and again, it doesn't matter. This pays you at home, pays you at work, pays in addition to any other insurance, and if you don't use it, you have a return of premium feature. You and your spouse are covered up to $100,000 accidental death benefit. The kids are covered up to $25,000. When they turn 26, there's a 30-day window without proof of insurability, where they can have their own individual plan at these special group rates and just continue their coverage. So if they're in the middle of leukemia or cancer or something like that, they can just continue it, sign up within that 30-day window, and they can keep this forever, return a premium and everything on it. We also have on the accident a doctor's rider benefit. What that means, let's say you fall out of that chair, fall on the floor, dadgum, I think I broke my hand. But my doctor's right next door. Let me go over and see if it's broken. You go over there. He takes an x-ray. No, you're okay. Get out of here and go back to work. Well, they send you a little over $200 every time on that. And I did 7 of those, I believe 7 of them in the past 12 months. And I got like $1,500. I call it the close call rider. I fell up the stairs. I thought I broke my hand. And I thought, and my copay is $27 each time. And I thought, just for the break, even if it's a hair fracture, that's $1,200. So I thought, that's some vacation money right there, you know, but no, it wasn't broke. And Elias got hurt in wrestling at high school. David was clowning around and a kid hit him in the ribs. Oh, my ribs are broke. So yeah, all these stupid little incidents, go to the doctor or Instacare or emergency room, and even if you didn't get hurt, you get money for that. And you can get me on that as many times as you want to, and I'll process every one. Just give me a call and we'll get in the loop. So I'm going to go right down the list here. I did tell you that you and your spouse are covered accidental death up to $100,000, the kids $25,000. Dismemberment, $25,000. So if you lose a leg, that's $25,000. A finger's not that much. It kind of breaks it down in the plan there, pardon the pun. Fractures pays up to $2,400. If it's multiple breaks, you get multiple pays. Dislocation is up to $2,200. Cuts, $300. So on a vehicle accident, we may pay you a dozen of these benefits. So the more damage you do to your body, the more money you're going to get, regardless. Hopefully your major medical will pay everything, and this is just cash in your pocket. Injuries requiring surgery, $900. Burns, $900. Paralysis, $6,250. Now this is a neat benefit. If you or your spouse or kids have an accident and they put you in a regular hospital room, we start paying you an income of $300 a day, and that pays every day you're in there up to 1 year. If it's intensive care, you get $600 a day, and this $600 a day pays in addition to this intensive care 10-day scenario I was telling you about a while ago, where I got $35,000 on a 10-day event. If you have both plans like I do, and a lot of the law enforcement people, then I get another extra $600. So rather than $10,000 and $15,000, now I get $16,000 for the wife, $21,000 for the child. That's $53,000. Again, that's some pretty serious money. You just hope you don't need it. Good peace of mind knowing you got it, just in case. Your ambulance pays on ground or air. Emergency room services, $300 each time. If you have to drive 100 miles to get care, they put in another $400. So if you guys are up close to the Idaho line chasing a criminal or whatever, get injured, that'd be $700 between the ER and the 100 miles deal. That'll help your deductible. And we even pay $100 a day up to 30 days each time, so other family members can eat and lodge nearby. Doctor visits with chiropractor, physical therapy. You get 8 physical therapies per accident, which is a real nice little benefit. Medical imaging, MRI and CT scans, medical appliances, wheelchairs, walkers, crutches, leg braces, back braces, prosthetic devices, $500 each time, and blood and plasma. So, any cancer, skin, blood, bone tumor, leukemia, Hodgkin's, or any intensive care or critical care for any reason whatsoever, or any type of accident, we can literally pay you thousands of dollars to help with your part of the bill, as well as plenty of money to live on. But did you have a question?
Excluding melanoma still?
Yeah, if you've had a melanoma on just the cancer coverage only, you can't get on the plan. That's what my dad had, and you just need to get on that before. Underwriting may change it in the future, but I don't know, because melanoma just, you never get rid of it. And it shows up here and there, but Dad made it 31 years before it took him out, so just get your checkups regularly, and you know, he made it to 86, so, you know, just get your checkups. Let's see. But the best part about it is what happens if you don't ever use this coverage. We have a return of premium on each one of them. The cancer in the ICU has 100% return of premium. The accident has 100% return of premium, and one doesn't affect the other one. So here's the wording on it. And Jenica, Diane, well, might need to get them a hearing aid for Christmas. There was a lady that was at the admin office yesterday, and she she just said, I want to tell everybody about this return of premium. She said a few years ago, I've had to, what was that lady's name yesterday at the administrator that told everybody in the group about the return of premium? She's a county employee. You didn't, I think Jenica, I don't know if you was there, but I was going to say y'all can ask the lady, I'll get her name, but because she aired it out and it was a great commercial for us. She said a few years ago she got this check in the mail and she forgot she had this, and it was all of her premium to you. You don't have to call, fill out a form or anything. Here's how it works. I don't know. Anyway, here's how it works. With the return of premium rider, you can receive a check for all premiums paid minus any claims every 20 years or age 75 if that comes sooner. And don't freak out, you'll get to my age sooner than you think, I'll promise you. But I'm 65, so if I get on the plan today, I just have to wait 10 years and I get all my money back, and then I still keep the coverage, you know, for the rest of my life. But the 24-year-old that's in the other building yesterday, you take that individual, you know, he gets all of his, he's 24, he gets all of his money back at 44, 64, 75, and then at 75, most companies cancel you or jack the price up or cut the benefits. We don't do that, but every 10 years you get half your premium money back. So it's a win-win situation any way you cut the cake. Let's say I take the plan out and I keep it 20 years, I put $10,000 into it, and I have no claims. The company's going to send me a check for $10,000, and that's all those years. That's been after tax deduction, so my tax is paid on that. Okay, I've already paid the tax, so that's my money, pretty much free and clear. But still, ask your tax man or lady that question. But let's say in the next 20 years I put 10 into it, and I had a $2,000 claim. They're going to take $2,000 off the 10, send me a check for $8,000, and it starts all over again. But let's say in the next 20 years, I have a lot of claims. They pay me $20,000, $50,000. Let's say they pay me $100,000 in claims. I'm not going to get any of my money back in 20 years, but I made a real good decision on picking the plan. Plus, it goes back to zero, and you collect again. The next 20 years, if you have no claims, you get all that money back. So, as I said, it's a win-win situation. Mike, do you have the price sheets on that? Well, let me just go over the price sheets. And we have some what we call loaded folders with all the brochures and the prices on them, but notate the price. Is everybody married folks in here? We got single parents. Everybody married? Okay. All right, good. And this has our contact information, but we'll give you the loaded folders with the prices, but jot the prices down because it's got some personal information on it. And if you want to get on it, just contact Diane or turn the worksheet into her, and she can contact us, or call me or Michael on the if you want to sign up. And they don't start the deduction until the first part of January, and the January check. So if you do sign up for the coverage, you'll get your policies in the mail in about 2 weeks. So basically you get till the January the 1st to ponder on it, and if you decide, we're never going to get cancer or have an accident, you know, just cancel the plan. Tell Diane just to cancel it, and the deduction will never go through, and we'll still be friends. Fair enough? assuming everybody's a family, in the family, and if you just want to get an individual accident in the family on the cancer, you can cut the cake any way you want to. But on the cancer plan, with the intensive care rider, that 10-day rec I was in earlier, so if you get that plan for the whole family, it's $28.67 a paycheck. You get 26 paychecks a year, and that's what your deduction is. If you get the accident plan, it's an additional $25.90 per paycheck. So if your family, husband, wife, and kids, that makes it $54.57 per paycheck if you get the whole shebang, okay? And individual speaking, if you get the cancer plan individual with the intensive care, it's $15.56 a paycheck. If you get the accident, it's an additional $13.80. We got price sheets on this. You can take one or the other. Most people take the package because it's a great benefit plan. It's a good way to save money. And everybody's going to tell you, they feel like it's a lot better to have this protection and never need it and get all your money back than to wake up someday and need it and not have it and then go tear up your savings, retirement, or 401 or something like that. So this is a better way to go. And that's it. Any questions? Everybody's pretty much tired. Sorry about that, folks. We'll be right back there in the back at the end of the meeting and give you the folders and any questions or help we can do for you, okay? Thank you very much. Whoops.
Thank you.
I better disconnect. Don't say I never gave you anything.
Thank you.
Yes, ma'am.
All of the insurance people will be a few minutes if you have any questions. Feel free to talk to them. Remember, if you were on the flex spending plan before, I do need to fill out the new paperwork and get it. The sooner the better, I think. What's the max on the?
IRS gave us a cost of living increase of $50 last year and no cost of living increase.
You don't need to change any insurance forms if you're still working.
Pretty interactive, let's put it that way.
Oh, good. Wait, no.
They won't be, they might be using them. They're really not that bad, though.
That's okay, I get it. Okay, Bunny's my favorite.
No.
Okay, it's in the back.
Okay.
That's it.
Okay.
Well, I think we're going to stop and get a lot.
Thank you.